Welcome to Finance This, Property That. My name's Dion Fernandez, and this podcast is for property enthusiasts, time-poor professionals, self-employed borrowers, and strategic investors looking for residential or commercial property who want more than just a low interest rate. They want a strategy and a team around them. Each week, I'll share strategies, structures, and lending moves that actually grow wealth, not just get you the loan. And also, I will help you surround yourself with information from professionals in their field. If you're here to build smart, not slow, you're in the right place. My vision is to empower financial legacies for generations. I am a mortgage planner and finance strategist, and I work with doctors, developers, business owners, and high-income earners to build serious property portfolios. So without further ado, let's get into today's episode. Hey everybody, welcome to this episode of Finance This, Property That. I wanted to share with you something that's been happening in the last few weeks. I'm going to talk about why valuers are killing your property deals and how to respond, which is the more poignant point. So, over the last few weeks, we've actually had a few low valuations, have been able to challenge them, some successfully, some not. I'm going to share with you a very extreme example. I'm actually going to share with you two examples of one we got overturned and one we didn't get overturned. But let's have a look. Let's just hit the, get the, I guess, how do I say this nicely? Let's talk about the elephant in the room. Valuations and valuers. Yeah, some valuers are really, really good for certain things. So like, I know the valuers that are really good at rooming house, which is with the Class 1B properties. But when it comes to residential valuations, because the rooming house is a commercial type, I've got more selection over that. Whereas residential, I have very, very minimal selection over the valuer. That's why when we do a recommendation, we recommend 2 to 3 different lenders, and we do valuations with 2 to 3 different lenders, because I can tell you that I have had up to a $750,000 to $850,000 discrepancy on one property. And I'm going to talk about that in a sec. 3 different valuers, 3 different values, but it's the same property and you have the same information. Blows my mind how that works, but we'll go into that in a sec. So why do valuations come in low despite some market growth? Well, if I had the answer to that, I would let you know. But it really does depend on how the valuer is assessing it. The lenders actually have what's called a standing order, which all valuers need to abide by in most cases. Now, in my head, you'd probably say that there should be very, very different, very, very minimal difference between valuer to valuer. But like I said, I've had 3 in the last 3 months where we've had different valuers value the same property at different prices. So I'm going to put it out there. I'd love to have a valuer on here, and you can tell us how you guys do that and why you come to the decisions you do. Because the key factors that valuers do focus on are comparable sales in the area, the market confidence. What does the house actually look like? And here's a key tip. If you're trying to sell your house, make sure it's clean, because if it's dirty, well, it might actually reduce the value, because it may not be, because it's not presentable, it may not be for everyone. There is a difference also between a bank valuation and a real estate valuation. Very, very simple. The bank valuation is for mortgage purposes. A real estate valuation is, hey, we'll get that value, but we're going to have to put a marketing campaign, etc. But it could take 6 months. The bank valuation is if the bank had to sell that property tomorrow, this is what they'd reasonably expect to get for it. Cool. So how do you challenge a valuation? Well, you as a consumer probably can't do that. That's why you need a broker to do it. Usually, if there's a purchase involved and the contract of sale is, let's say, 700 and the valuation comes in under, which it's really rare, but it actually just recently happened to me or to my client, we would go back to the real estate agent and go, hey, this is the valuation that's come in. Can you shed some light? These are the comparable sales that we've got on the report. Do you have any comparable sales within a certain area or in that same suburb that they haven't used? And if the real estate is really on the ball and they're selling these properties for what they should be sold for, well, they have got the evidence. Now, in some cases, there may not be enough evidence, and even though we can take those comparable sales and show the valuer the comparable sales, most of the time the valuers aren't going to change their minds. It's actually really, really rare that a valuer will change the valuation for mortgage purposes. So how do we get around it? Well, like I said before, we have 3 lenders and we order 3 valuations. So one of my clients, she has a penthouse in Auchenflower. Yeah, I know. Yep, penthouse, Auchenflower should be pretty good, right? But I know last year she got it valued at 3.1 million. Then that's in August last year, June, July, August last year. We came to refinance the loan. Luckily, I had 3 different lenders that this would go to. I ordered 3 different vals, and luckily for us, we actually had 3 different valuers go out there. Now, the bank that she chose that she wanted to go for, their valuer valued this property at $2.4 million. That literally meant we couldn't do the deal. We couldn't refinance her out. We couldn't save her $4,000 a month in repayments because she was on a really high repayment. And that didn't sit well with us. But luckily, we actually had other valuers that actually valued that property. One valued it at 3.15, another valued it at 3.25. That's a $750,000 to $850,000 discrepancy. That's the biggest discrepancy I've seen ever. But using that information, they had different comparable sales. I was able to go and challenge this valuation. And even though the valuer didn't budge, they stood firm with their 2.4 million, even though they used very different comparable sales and they weren't really comparable. Knowing the bank's policy that we were going to allowed us to challenge the valuation, challenge the valuer, get a check val. So the bank ordered its own independent check valuation. And what do you know? The check valuation came in at $3.25 million. What that meant to that client was we were able to get that approved straight away. We were able to use that valuation based on the evidence that we had and got the deal approved. It should settle. We got it approved actually within 24 hours of submission, but we did the valuation work before the application was submitted. So we knew exactly what we were going in with. I slowed the process down because I knew we'd get approval on servicing and policy. Just needed to get that last piece of the puzzle, which is the valuation done. So that just goes to show that working with a broker that actually understands the policy and understands valuation process and how to challenge valuations and how to get the banks to see the mistakes and the policy and use their policy to the best advantage to support you as a client is really, really important. Whereas on the other hand, I had another client buying under their SMSF. They purchased for a contract of sale price $690. This value has gone out there and valued the property at $630. So that's a $60,000 difference on a contract of sale. This baffled myself. This baffled the real estate agent. And it also it also baffled the business development manager for the lender, because they couldn't see why it was there. They've used comparable sales from last year because they couldn't find comparable sales in the area. However, even though we found a comparable sale within a 10-kilometre radius in the same postcode, it's an inferior property. They stuck to their guns and they didn't want to change the valuation, which, look, they're well within their rights to do. It is their insurance up on the line for that, and that's okay. But this meant the client couldn't purchase that property, because if we were to use all the funds in the SMSF, we couldn't use that. It wouldn't be the best outcome on their SMSF, which would leave them very, very short on cash inside their SMSF. And that's really not a great strategy for that. So we had to pull out because of finance, which was fine. We were able to write a letter and go from there. But we couldn't move it to another lender because of the servicing position required for this particular property. So there are two really good examples of one where we have challenged and been successful, and one where we haven't. We don't always get the challenge right. However, I can assure you that if I think that there's something wrong with that valuation or it doesn't make sense, we definitely are challenging it and being very, very proactive around it. So there's a little bit of an example that even though the market's going up, valuers are still trying to maybe be a little bit on the conservative side in some places, and then you see other valuations come up at you wouldn't even realize that they'd actually come up at those values. So long story short, it always pays to go with the strategy. That's why we actually have 3 different lenders that we normally choose from. We get the valuations on all the lenders to make sure that we can be agile as we can. And we actually, when we submit the application, we're submitting it for approval and settlement, not just hitting and hoping. So thanks for listening today. Like I mentioned, this information on this podcast is very general in nature. Doesn't take into consideration any of your circumstances. You want to have a chat? I'm very easy to find. Instagram at Dion Finance Specialist, LinkedIn Dion Fernandez. And also you can jump on the website, financethisproperty.com.au, for all the missed episodes. You can listen to Apple, Spotify, YouTube. But until the next episode, thanks for listening, and I'll see you then.